Okay, well, welcome back to Intro to Financial Services. This is where this starts to get really complicated. So if you're lost from the earlier videos, you're really going to get lost here. But I'll do my best to get through this quickly and to try to uncomplicate it. We're going to talk about derivative contracts, derivatives, which are very complicated. I got to put the disclaimer in here. This is really just an introduction to 10,000 foot level simplified. If you want to go in more detail, read the book after the trade is made. Okay, I'm going to make no financial advice here. I'm not going to make any advice one way or the other about derivatives. I actually could get in trouble for using this cartoon. I hope the artist will forgive me, but Ziggy did this cartoon at one point, stock options 50 cents. And it's in a theme that, derivatives are complicated. So what are derivative contracts? A derivative is basically a financial instrument whose value is derived from the underlying value of another security. So here's some examples. And I'm going to spend most of this time talking about stock options and options as derivative. An option is the privilege sold by one party to another, offering the holder the right but not the obligation to buy or sell a security at a strike price at a certain time. So an option is the right but not the obligation to buy a security sold by one party to another. And I'm going to go through this in detail. It's going to explain it a little better. There's also future contracts. I'm not going to spend a lot of time talking about futures. The futures market is very different, but this is where, if you saw the movie with Eddie Murphy and Dan Aykroyd, Trading Places, where they're dealing in futures, commodity futures on frozen concentrated orange juice. That would be an example of futures contracts. And then there's forward contracts, which is a cash market transaction where the delivery of the assets underlying the contract is deferred to a future date. So a forward contract is a contract where you're going to get the stock of the asset, but you're going to get it at a future date. You're getting it now for delivery at a future date. Contracts are not standardized, and they are agreements between two parties. That's when you think about derivatives. Derivatives are contracts associated with an asset. Swaps are another type of derivative contract. The exchange of one security, currency, or interest rate for another. Swaps. And they're usually part of very complex strategies. Collateralized mortgage obligations, CMOs, we talked about these earlier. It's a type of mortgage-backed security that creates a separate pool of pass-through rates of different classes of bondholders with varying maturities called tranches. Bonds are retired, repayment from the pass-through pool in the order specified in the prospectus. I'm not really going to go any further into CMOs. I just can't get into that level of complexity. We're going to talk mostly about options. But I guess the idea I want you to get away with here is that the derivative contracts are only limited to the creativity of whoever is writing the contract. Someone who's writing a contract based on an underlying security. There's a lot of complexity. There's a lot of creativity. There's new derivative products rolling out all the time. Again, I hope I don't get in trouble with the artist for using this cartoon, but basically, little girl comes to grandpa and says, "What's a derivative?" The father says, "It's a bunch of rich banker types did to make themselves even richer. Businesses folded, jobs gone, foreclosures, the whole financial system collapsed." She says, "Well, what's a derivative?" He says, "Who knows?" And that gets to the point that people don't really understand derivatives. So we're going to talk here about option derivatives. The option is a contract that derives its value from the underlying value of another security. So for instance, if you've got a stock and you've got shares of the stock, 100 shares of the stock, those 100 shares of the stock are the underlying asset. And then you can write contracts against that underlying asset. So contracts are written to control 100 shares. So you can write an option contract that controls 100 shares. So one option contract controls the buying power of 100 shares of the underlying stock. So let's say I own 100 shares of this stock. I can write a contract that I will agree that I will sell you this stock at price X by up until expiring on some date. Maybe that date is 2 months away. So let's say the stock is currently selling for $50 a share. I can sell you the right to buy it at $60 a share anytime between now and 2 months from now. And, you know, I'm basically hoping that you're going to, the stock price is not going to go up to 60. It's going to stay where it is. But if it does go to 60, you're going to exercise this contract, and I'm going to sell you the stock. But if it doesn't, well, you paid me a small premium for the contract, so I can get passive income on the security. That's the idea. That's the underlying idea. The contract derives its value from the underlying asset. So why do people like these? Well, it provides leverage. The main advantage of trading stock options is simply that they provide leverage. Options enable you to control shares of a specific stock without tying up large amounts of capital in your trading account. The amount of capital, which is the premium, what you pay for an option is called the premium. And by the way, once you buy the premium, it's gone. You don't get that back. It's a one-time spend. But the amount of capital for the premium is relatively small compared with the buying power. So for a small premium, I can buy the rights to buy or sell a stock by a future date at a certain price. And that provides leverage. The capability to invest small amounts of capital and control stock gives the options trader the flexibility to trade higher price stocks, the big movers that are normally out of reach for smaller account traders. So it's leverage. The other leverage is because the premiums are relatively small for controlling larger pieces of stock, it magnifies the profit in your favor when your strategy is successful. Makes money based on a relatively small investment in stock. Okay, the other thing is for the person who's writing the calls or puts, it's passive income. So certain income producing option strategies enable you to generate monthly passive source of income. One of the most widely used strategies to generate passive income is to write covered calls. So I own the stock, so I'm covered. I own the stock. I'm going to write calls. Those are covered calls. Traders who deploy this strategy is acting similarly to a landlord who bought a house and earned rental income by renting, writing covered calls on the stock to another person. One key point to take is that in this oversimplified example is that the trader who wrote the covered call may be forced to sell your stock at the exercise price, right? So basically it's a passive income, but you might have to actually sell your stock at that price in the option, right? So again, I mean, that's why people like this. It provides leverage and passive income. So profit from bull markets and bear markets, sideways market. There are various option strategies that give you options for traders. I guess the point I was want to make here is options are part of a very sophisticated strategy where whether it's a bull market or a bear market, a sophisticated trader can use options to create strategies that can be profitable. It also hedges their risk. And what are the disadvantages of options? The first is time decay. If I have an option to buy a stock at a particular price 2 months from now, that's great. But as the calendar goes by and we get closer and closer to that date, that getting closer and closer to the date is the time decay. And eventually, when you reach the date, the expiration date, if the option is not in the money, doesn't have value by that date, then it expires and becomes worthless. So unlike stocks where you can hold on to it for many years or even pass it down to your children, all options have an expiration date. Remembering that options is a wasting asset. There is nothing you can do to stop the option from expiring. The rate of time value decay increases over time when the option gets closer to the expiration date. Therefore, be sure to watch your options, your open option positions, like a hawk, unless they become worthless. And then full loss of investment. This is the other problem with an option. Yes, you paid a small premium for the option, but at expiration, if that option doesn't execute, you lose that full premium, right? If you hold on to a trade that goes against you and the options are out of the money at expiration date, you may lose every single cent you invested in the options. So all the money you paid in the premium to buy the options, you can lose them. Leverage. Go back to leverage. And on the disadvantage side, if you feel that losing all your money in investment is bad, wait till you're aware that you can possibly lose every cent that you have writing making options that goes against you, right? Now, naked options are where you write options against stock that you don't even own, right? The same leverage can help you earn profits in the short term and break your account in half just as quickly. Again, options, very high risk. They're meant for sophisticated, qualified investors. They're not for unqualified investors. It's a very speculative. Options are meant for qualified professionals who know what they're doing and can afford to assume the risks. They're not for your average person. That ends part one of my presentation on options. Part two, I'll go into more details on what calls and puts are. And if you have any questions, please contact me at the address listed here. Thank you.